If you've come in for this session, you're in the right place. We're going to hopefully give you a good overview of some of the key terms of term sheets and things that founders should watch out for. I'm your host, Robert Hoken, Greenbackers Investment Capital, and in brief, we're funders and enabling funding for net zero and climate technology. What this slide really means is we bring two groups together. We bring investors together with ventures, and we make deals happen. So we're rainmakers in this space. We do it via a showcase. This is something we developed during the pandemic. It's now our flagship program. It's an online platform, a series of mini data rooms where investors can meet with pre-screened ventures. Investor feedback is very positive. They like the fact that they can look at pre-screened ventures and see a lot of them quickly and screen them out. One thing I'm going to ask again to all of you new joiners, if you can mute your mics, please mute your mics so that we don't have too much feedback on this recording. Thank you. I'm just going to, we're deal makers in the sector, and we kind of stop where Brown Rudnick comes in. So this is a good partnership, a good session for us. Sarah Mullaney is a partner in the corporate team at Brown Rudnick, and she's been working with cleantech technology companies for the majority of her career, ever since I've known her. She specializes in working with high growth companies. She advises them through all parts of the life cycle from inception to exit. And having acted as quasi general counsel for a number of high growth companies, she understands the pressures facing entrepreneurs, and I think she tailors her advice well accordingly. She also acts for a number of venture funds, such as Ananda, VC, Downing, and Mercia. And I think this balance allows the team at Brown Rudnick to really understand the key drivers for decisions and maintain a good overall view of the market. Brown Rudnick is really one of our go-to people when it comes time to negotiating term sheets. Sarah is also the co-head of the impact investment team at Brown Rudnick and founded their Women in Business initiative, which I believe she'll introduce at the end of the seminar. And last week, I understand that Sarah received rankings in the Legal 500 for venture capital, TMT, and M&A with a Legal 500 rating of Sarah as next generation partner. I think that's awesome. That's a big deal, I think. And congratulations, Sarah. So without further ado, I'm just going to unstop my share and let's have a little bit of a chat with Sarah. Should we start with the basics? For a lawyer, what's a term sheet?
So it's always good to start with this term because it can be basically misconstrued. So basically a term sheet can have multiple different names. It can be referred to as a memorandum of understanding. It can be referred to as a letter of intent. People refer to it as head of terms, term sheet. The choice of designation is largely one of kind of personal preference. It doesn't really have any sort of substantive effect. The one thing that you need to bear in mind is that it's a key document in any venture capital transaction. So by focusing on the term sheet early on, it basically focuses the attention of both the company and the investor to the major business and structural issues that can arise in relation to the proposed investment. And when you're working through a term sheet, the parties can relatively quickly reach an agreement on major terms, or they maybe realize that they're just not going to find that common ground so that it's makes the investment feasible. However, the one good thing about a term sheet is that if it's carefully drafted and prepared, it can actually save you both time when you come to draft the main documents and expense. Obviously, if we know what the terms are, we're not going to be negotiating them as we're trying to prepare these documents, which can run to about 80 pages.
Sarah, thank you. I think you accidentally muted. So could you repeat what you were saying before? You cut out after you said term sheets can extend to about 80 pages.
Yeah, well, term sheets won't extend to 80 pages. The investment documents and the articles will run to about 80 pages each. Your term sheet's going to be about 3 or 4 or 5 pages with the key terms in there. But basically, if we know what the key terms are, we can prepare drafts for you that reflect the term sheet, and we're not going to be negotiating them as we're preparing them. So it makes the whole thing a lot easier. We'll be able to turn the documents. When we say turn, we mean, prepare one copy and send it to the lawyers on the other side. And we should be able to kind of reach an agreement within maybe 2 turns. Whereas if the term sheet is pretty poor, we end up going back and forward on a number of drafts, and it just increases the price for you. So the next thing to bear in mind about a term sheet, despite everything I've just said, is that it's non-binding. There are certain clauses that will be binding. So costs, generally each party will pay its own costs in preparation of this and the documents. Confidentiality, people need to maintain confidentiality about the deal that they're entering into. And you might have exclusivity in there. So you might say to an investor, particularly if you're very popular on the investor circuit, which you will all hope to be, that they can have exclusivity for a defined period of time, and that clause will be binding. Even though we say they're non-binding, I can't tell you the number of times where I've been through an investment deal and when trying to negotiate something and somebody will go, well, it says that in the term sheet, why are we departing from it? So the negotiation of a term sheet is vital, and making sure that you have the right terms in there is absolutely vital as well. So really, for purposes of this discussion, and bearing in mind we haven't got hundreds of time to go through today, terms in a term sheet are divided into 3 categories. So we're talking about, firstly, terms which impact the valuation and economic division of profits and proceeds upon a liquidity event. We're talking about terms that basically impact control over decision making and reasonable market investor protection terms. And finally, the one for all of you founders out there, which sometimes gets missed off, but it shouldn't, is management terms. So the one thing to bear in mind is one size doesn't fit all. So you cannot pull your term sheet down off the internet. It will not work. There are different things that affect different companies. You're at different stages of development. You've maybe one founder's been working on this for 10 years, one has been working on it for 4. One size does not fit all. But really, the main thing is that your term sheet should have your kind of deal-breaking issues that often arise in terms of management terms, such as continued employment, your new salary. You might not have been drawing a salary, and in addition to that, you might want to cover off areas around intellectual property as well. So basically, one thing to remember on a term sheet: 1, take it very seriously, and 2, make sure that you've got somebody who knows what they're talking about when you're negotiating those terms.
So Sarah, you noted in the introduction you'd focus on these 3 main areas. One of the things that you mentioned first was, and probably most vital, are economic rights. I mean, how often are these actually set out well in a document in your experience?
So before we get into that sort of the economics, I think the one important thing for people to understand is the difference between what we call ordinary shares and preference shares. These are the 2 common shares that will come into play on a seed round or a Series A round. The institutional investors will always ask for a preference share. They might call it something different. They might call it a Series A share. They might call it a seed series share. You can name your share classes anything you want. There are commonly used names. The name doesn't mean anything. It just means that there are different rights attaching to each class. So the ordinary shares are the ones that you will have incorporated the company with. They're the ones that you probably hold. The preference shares are the ones that carry additional rights for your investors. And my main hint on this is that you want to try and keep it very simple. So while you might offer a preference share on your series, your seed round or your Series A round, you don't want to be offering 7 different share classes, because what that can do is it can dissuade investors in the following round. It can make it incredibly difficult to exit, you just, it's just going to make your life difficult. So just remember, preference shares are fine as long as somebody's paying a higher valuation for them than the ordinary shares. Where you have angel investors coming in, I would try and keep it to ordinary shares. They're probably aligned with you on your bottom line. For companies like you guys, it's going to be people, planet, profit. So they're aligned with you. They should have the same type of share. Now, as Robert was talking about, there are economic rights attaching to the shares. And one of the most important rights in any term sheet is what we call a preference upon liquidation. Now, it's referred to as a liquidation preference. It's referred to as the waterfall provisions. The name liquidation preference is a wee bit of a misnomer, because basically a liquidation preference dictates distribution on any type of exit, whether that's a company going into liquidation, whether it's an IPO, whether it's a sale, whether it's an asset sale. And so the liquidation preference talks about who gets what money on the exit event. So say, for example, you have an investor come along and he asks for a preference share. That preference share will entitle the investor to receive, upon liquidation, an amount equal to his investment or some multiple thereof, prior to distribution of the proceeds to the holders of securities which might rank junior to that preference share. And your term sheet really needs to kind of bottom this one out, because it's the most important term. And there are different types of liquidation preference that attach to shares. We have what is called a participating preference and a non-participating preference. I'm going to start with the one that you see most commonly in the US, and it's starting to come in more and more frequently in the UK. The UK usually follows the US on venture terms, but non-participating preference share is basically entitles the preferred shareholders to receive only the amount of their preference, plus any accrued and unpaid dividends on exit. So basically, you commonly see that they'll get 1 times their subscription price. So if your investor has put in 500,000, they get that £500,000 out before you receive anything. Once that £500,000 is paid, you receive the rest. Now, say, for example, the company was going to sell for 3 million. The investor is not just going to sit there and take its £500,000 back and wish you good luck. What will happen with a non-participating preferred share is that they will effectively convert their preference shares into ordinary shares so they can participate with you on a pro rata basis. Now, the ugly one that we sometimes see is what we call a participating preferred stock. And this is the one you kind of want to resist, because the investor will get their preference amount out first, so their subscription amount of £500,000, and then they get any remaining proceeds as well, because what happens is those remaining proceeds are divided between all shareholders, so the ordinary shareholders and the preference shareholders. So they get the £500,000 out first, and then they get to participate in what's left in the rest of the pot. Now, that to an extent is almost like a double dip. And so you should be avoiding them. I would definitely say that a participating preferred stock provides significant benefit to the investors at the expense of the founders and the very, very early stage investors. It is, as I said, one of the terms which is under great negotiation, as it's the one that has the greatest impact on any kind of distribution of assets as you exit the company. The other thing that you need to be aware of is what we call an anti-dilution right. So an anti-dilution right is effectively valuation protection. Investors will typically request that a right is included within the documents so that there's an adjustment in the event of a down round. So to give you an example, Series A, you raise 100 shares at £100 per share. Sorry, you raise money at £100 per share. And then you have a Series B where you raise money at £50 per share. And the investors will want to protect themselves, maybe for having got the valuation wrong in the first place, by asking for the issue to them of a top up of shares so that they're almost, they catch up the difference in the valuation. There are different ways of calculating this, and by far the kind of most commonly used and the best from a kind of founder's perspective is what we call a broad-based weighted average. And that will effectively take into account all of the stock in issue, all of the shares to be issued, and it's the most fair. By example, the one that you do not want, I repeat, you do not want, is the full ratchet formula. So basically, these are really, really investor-friendly types of protection, but they're also the most dilutive for the ordinary shareholders, which includes the founders, basically because the full ratchet formula results in the greatest number of anti-dilution shares being issued to the investors, which then will dilute you down further. Now, if there is an argument around that, the way that I would push back on it is investors will probably say, look, if there's an anti-dilution round, it's probably something that the founders have done. Well, that's not always the case. We've just lived through COVID, and I can pretty much say, unless you were kind of patient zero, that you didn't start the pandemic, and therefore it's not your fault that it's had an impact on the economy as a whole. So those are the ones to really watch out for when you're looking at the economic rights.
So a lot of devil in the detail, really. Do you want to spend some time talking about the subscription agreement and articles seeking to control corporate governance, Sarah?
Yeah, so the next one to kind of think about is corporate governance. And often when an investor comes in, even though they're putting in a substantial chunk of money, they may not be getting a substantial chunk of the business. So they might be kind of in that minority bracket. And so they'll look to kind of protect their investment by not only the use of the economic rights, but also by implementing vetoes. So when we talk about veto rights, it's exactly that. It's the investor's ability to veto a decision. And the one thing that you should be aware of is, one, these are entirely standard and you shouldn't be afraid of them. They should appear in your term sheet if your investor's a serious investor. However, a lot of investors will talk about the BVCA standard term. Now, the BVCA is the British Venture Capital Association. It is, all the VCs are members of it, and the BVCA standard forms were written by investors for investors, and the list of vetoes in the BVCA standard form is fairly long. Now, there are some important ones in there, but you should not accept that whole list of vetoes, really from a perspective that it is going to hamstring you in making any decisions on your business going forward. But there is a balance to be sought. And so the things that you might consider accepting are changes to the articles. That is a definite one. You might want to have one over kind of putting the company into liquidation or insolvency. You might look at accept an exit, changes to board seats, taking on new employees where their salary is above a certain figure. These are all really standard things that you can accept, but you do not want a whole list of vetoes in there, because it will be very, very difficult to just run your business, because you'll always be thinking, I need to go and get a veto for this right. The other thing you might want to think about as well is how, who has those veto rights. So for example, you may have 5 investors come into your round, your Series A round, and do you want to go to all 5 investors every time that you need to get something approved from the veto list? Well, no, because it can be difficult. People might be on holiday. So what we often do is, where there's more than one investor in a round, we'll basically talk about an investor majority. So if there are 5 investors, then you only need the consent of those holding, say, 50% of the investor shares, so 50% of those preference shares. And that gives you a little bit of flexibility around, how quickly you can do things, and who you need to speak to. The other one that people will often ask for are board seats and observer seats. Now, board seats and observer seats are things to be considered. A board seat is somebody who sits on a board with you as a director. An observer is somebody who can sit in the meeting but doesn't actually have the right to vote on any of the matters set out. The one thing to be very aware of is making your board too big, because as soon as you agree to have 5 investor directors for your 5 investors, you've now got a board of, say, 6. You will want at some point to bring on non-executive directors who are independent. They've been working in your field for a very long time. They have an awful lot of experience and connections. So you might want to add them on, and then you find your board starting to snowball. And so you need to think about whether the investor should be an investor director or an observer. And what you often find is there's typically a cutoff point. So say if they're above, for example, 10% or something, they might get an investor director seat. That then falls away if they are diluted below 10%, which is really good for further rounds, because unless they're following the money, then they shouldn't be able to keep holding that seat. So that's what to think about on board seats. The other thing that you will want to think about in your documents are kind of what we call preemption rights. Now, preemption rights generally kind of cover 2 things, even though technically I would say that they both don't have the name preemption rights. People do often say preemption rights apply to both the issues of shares and the transfer of shares. So on the issue of shares, that's where you bring in new investors. And what you don't want to be doing is giving a preemption right to non-institutions. So, your angel investors and things like that. I think it's a little bit illusory when you get to the point where, you're raising shares you're raising money at kind of £200 a share, whatever. The kind of early stage guys may not follow that on. It's always going to be institutions that are investing in those rounds. So that's one thing to be aware of on issue of shares. And then on transfer of shares, people call it preemption on transfer. It's also referred to as the right of first refusal. So for example, Robert has shares in a company, he wants to sell them to me, but all of you are his existing shareholders. The Companies Act provides, and in your constitutional documents will also provide, that he has to offer them to you before they're offered to me. Now, generally with transfers of shares, the BVCA standard form will say that, if Robert has £5 of shares that he wants to transfer to me, there should be a valuation mechanism in there. It's too expensive. It should be cut back, and for minimum transfers, this should be a really easy process to go through. So another one to be aware of.
So much food for thought here, Sarah. Yeah, just looking at the guest list today, your majority of the audience are founders. Could you, and given we have about 4 minutes left before the half hour, maybe we should risk going over, but could you take us through some of the issues that management may wish to consider when preparing their term sheets?
Yeah, so first things first, guys, if you're early stage, you probably haven't drawn a salary for months. Make sure you negotiate your salary within the term sheet. Really important point. People forget it. but I'm guessing at this point you'll want some money. So that's the first point. The second point is what we call restrictive covenants. So these are basically to stop you going out and competing with the business. So an investor puts money into the company, you decide, do you know what, I'm going to go off and set up a competing business over here with all my knowledge. They don't want you to do that. So restrictive covenants will always pop up in an agreement, but you want to be very careful as to the time and territory, because, you know, for example, they might say that you have 1 month's notice under your service agreement, but you can't work in the same industry for 12 months. Can you really afford that as an individual? So you should try and get your notice to be, and your restrictive covenant period to be on kind of similar terms. The other one to think about is vesting. Everybody always forgets vesting, but really crucial to a founder. So, for example, you might think today that you own, 76% of the business. What will happen when you go into your Series A is the investors will expect you to agree to a vesting schedule, whereby they take all of your existing shares and they say that you have to remain with the company for a period of time before you can truly own those shares. And if you leave before that, they have to be transferred. So the standard is that there's a vesting period of 1 year, 4 years. There'll be a cliff in the first year, and then they'll vest at kind of 1/36 every month all the way to the end of the 4th year. That's pretty standard. It's important for the investors to know that you're going to stay with the business, because ultimately with very early stage companies, whilst investors are investing in the idea, they're also investing in you as a person and their belief that you can take this business to the next stage. So absolutely fine to have vesting, 1 year cliff, which is 25%, and then 1/36 thereafter. The bit to be careful around is around the leaver provisions. So you will see that there are things called good and bad leavers. The BVCA standard form basically says that you're only a good leaver if you die. That list should be increased significantly. And actually it should be completely flipped on its head. So bad leaver are really, really strict circumstances, such as, you are fraudulent, or you do something that results in the company gaining a really bad reputation or something like that. There should be minimal circumstances. Do not rely on the BVCA standard form. It is not standard. These are always negotiated. And the final one to talk about are warranties. And I had this crop up recently on a term sheet where the investors were putting in a sum of money and they were expecting the company's founders to stand behind the warranties for an unlimited sum of money. So to kind of break this down, warranties are statements of fact about the company. So for example, looking at Robert, it will say Robert is wearing a blue shirt with a black jacket over the top. Well, in fact, Robert's wearing a blue jacket, if I'm right. Maybe can't tell from the colorblind. And what you have the chance to do as founders is to go through those statements to say, well, that's not true for this reason, and you put it into a disclosure letter, and that's protection for you. So point number one, make sure you take the disclosures exercise. You do it properly, and you take it very, very seriously. The second thing is that if there's a breach of warranty, effectively the investors can come after you. Now, 9 times out of 10, it's not going to happen because the investor has money in the business. They're only going to do it if they really want to get out of the investment. And in the years that Neil and I have been working together, we've never really seen any warranty claims, because we're always saying to our founders, take this exercise seriously. You can, however, put limitations in there. So, for example, you can limit as to the financial limitations. So that's typically 1 time salary. And you can limit to time, and somewhere between 1 year and 2 years is about the kind of right time period. So they have to bring a claim within 2 years. They shouldn't continue on in perpetuity, and they shouldn't be uncapped financially. And as I said earlier, you're negotiating your increase in salary. That kind of goes hand in hand with those limitations.
So, Sarah, I appreciate that we're kind of coming up on time, but We've got some questions, and if you're happy to stay a wee bit later, I'd like to field some questions from the audience. Are you happy to do that?
Yeah, sure. If I can just add one quick point around when you should think about getting somebody like me or Neil involved. I would basically say that an hour on a term sheet with us is basically going to save you dozens of hours going forward in the long forms. It's really is your chance to kind of trade the important key terms, and you want deal lawyers to do this for you. Neil and I have been close. I've been working with Neil now for 10 years. We've been closing a deal every 2 to 3 weeks in that 10 years period. So we do know what's market. We act for VCs as well. We know what's important to them. We know where the wiggle room is. So we do term sheet reviews for a small fixed fee. And I know I sound like I'm selling right now, but I honestly, it will save you so much more hassle in the long run to get it done properly.
Well, let me ask the question, because we've got some deals coming up. If we had to put some of our cohorts up to you for a term sheet review, how do you charge for that?
So we charge a small fixed fee to do a term sheet review.
Mm-hmm.
Ultimately, we'll spend quite a long time with you trying to get to understand what your kind of aims are, where you want the business to go in the future, and things like that. But we do it for a small fixed fee, and then hopefully, you'll see the value, and we'll go forward with you not only through your Series A, but all the way up to exit, and do all those little bits in between. So we really see it as a value add for people. And as I said, please don't take a term sheet off the internet. I know it's tempting, but I actually think you're probably doing yourself a disservice.
So a couple of questions from the audience. Charlie Guy is asking, you were talking about vesting. Can vesting schedules be reset, and is that normal practice?
Do you mean, I guess, if you're going from Series A to Series B, yes, sometimes, but you're in a better negotiation position when you're resetting them. So you might want to push to have, say, a 2-year cliff where you get more in that initial period. When we talk about a cliff, we're basically saying for the first year, you don't really get anything, and then you get all the rights to kind of 25% going forward. So there is room there to negotiate it. Some people will try to reset it. And they do reset it as soon as they come in on a Series A, because when they come in on a Series A, you already own those shares. We're not talking about options here. We're talking about physical shares that you own.
Okay, and you mentioned vetoes and rights around vetoes. What is there anything around what vetoes are reasonable to expect founders themselves to ask for?
So as a founder, you will be sitting on the board. And so what you might want to think about doing is kind of splitting out some of the vetoes, and saying that they're subject to board consent with investor director consent layered on top of that. So you've got a little bit more control. The ones that you might think about are sort of changes to kind of the budgets, things like that. Generally, I would say, though, you don't want to kind of layer your approvals so that you're having to think about every time you have to seek an approval, who am I going to? As you're on the board anyway, you're directing the business. I wouldn't overcomplicate matters.
Fair enough. And by the way, David Morrison, yes, the recording will be made available afterwards. It'll probably be up on our website. We'll send you links to it tomorrow. Ed Ruddy, Sarah wants to know, can you please repeat the first hard no on the types of shares for seed funding, please?
So the hard no's on the seed funding. Basically, preference shares are normal for your institutional investors. Now, institutional investors, just to break that down for people, we're talking about venture capital funds, corporate venture capital funds, big angel networks that come in together. So that's those are the guys that you can give to. The hard no's are you don't want to be giving any preference shares to somebody who's giving you £100,000 check. You know, your preference shares are for those that are coming in with real money. You don't, it's not really a hard no, but I would say that your business angels or your family offices, because their reasons for investment are effectively more aligned with those of the founders, so people, planet, profit in this case, you can probably argue that they should be in partnership with you and be taking the same ordinary shares. The other hard no that I did mention is that you do not want to be offering several different types of shares on your Series A. You keep it simple. So you keep it to your ordinary shares and one preference shares. You might have two if you've got VCT, EIS investors in there as well. No more than that, because what it means is two things. It's something that might dissuade investors in follow-on rounds. And two, exits become incredibly difficult and my fees start to go up quite astronomically at that point.
Oh, let's take a last question here. And this was from Lori Reynolds earlier in the session when you were talking about the board, NXDs, and he was trying to understand what are the main principles which govern payments to non-executive directors. Are there any term sheet implications as well?
So it is standard to pay your NEDs. You will not typically pay an investor director salary. And an investor will potentially, not always, draw money via monitoring fees. So that's an annual fee, or via arrangement fees for actually executing the deal with you. So one thing to bear in mind is investor directors, you pay expenses, but you won't pay salaries. NEDs, you can pay salaries. I would say in the early days that, you know, your NED should be relatively understanding about the cash flow of the company and not be drawing too much out from, you know, the company on a monthly basis. There are different ways of handling it. You might want to say, for example, offer them unapproved share options, whereby they can participate in the kind of growth of the company. You know, you may agree to them to have like a salary that bumps up in the next round or something like that. I think you need to be careful that the investors don't see that the NEDs are draining the company of cash.
Fair enough. And thank you for staying late with us, Sarah. Did you want to say anything about the Women in Business Hour before we wrap up?
Yeah, sure. So one that I'm very excited about, we have been working on a new initiative at Brown Rudnick, which is called Women in Business Hour. And effectively, there are so many female entrepreneur networks out there, and they're all brilliant, but I really wanted to put together something that was going to be of real value to female entrepreneurs. And it actually kind of came about from a bit of a horror story of a friend of mine who is a female founder. She engaged the wrong chairman who gave us some really bad advice. She took on an investor for a minimal amount of money with a really bad term sheet. This was before she knew me, by the way. And ultimately what happened is that business was kind of driven into the ground, even though it was a good business. And so she's had to go through the whole process of buying the IP out of administration and then building it back up from nothing again. And for all of you founders on the call, you know how hard that is. So I was like, I really want to do something to be able to help. And, you know, Neil and I and the rest of the team at Brown Rudnick have years and years and years of experience. And so I wanted to give back a little bit. And so we founded Women in Business Hour. And what it means is that female co-founders or founders can sign up, and Robert is going to send you a link either today or tomorrow to receive an hour's worth of kind of mentoring from a lawyer. You can talk about, you know, term sheets if you want to. You can talk about employment. We can talk about tax, IP, and you can pick from a kind of menu of lawyers, so to speak, and have some free time with them to chat through things. Now we say an hour, we know that it's going to involve a little bit more of that in the long run. In addition to kind of the time that you get with us, you're also going to be able to, everybody is going to be able to view what we call the kind of Women in Business Hour homepage, which is going to have things like Spotlight on the Investor. So we're asking investor those kind of really important questions, like how much do you invest? What are you looking for in terms of making investments this year? Which sectors are you looking at? What's kind of a key point for a founder to bear in mind when they're pitching and things like that. And so that's going to be a fortnightly release where you can also search if you want to kind of look up some investors. We're going to be having events. There will be podcasts on there very similar to this, where it'll not only be lawyers talking, but hopefully we're going to get some investors talking about, you know, how the best way to pitch, what should be in your kind of pitch document, things like that. And eventually, as we grow, we're going to have kind of round table events with females and things like that. Now, I don't want to dissuade all the guys that are in the audience. So even though we've said this is Women in Business Hour, we are firm believers that we want to kind of help everybody from all walks of life. And so please do sign up. Just because you don't have a kind of that designation doesn't mean you can't join.
Well, fantastic value add there, and I think there are many in our network and on the call that'd love to take you up on that. I should probably bring things to a close right now. I'm going to share screen again so that people can see how to get in touch with you if they wish to. So again, you'll get a link to the deck, to the video, to the Women in Business Hour tomorrow after we do post-production on the video. There's Sarah's contact details below her photo, but I'll send it again in the body of the email to you. The last thing I just want to leave you with is Brown Rudnick and 26 Net Zero Ventures will be present at the Greenbackers COP26 Super Pitch on the 9th of November. So this is our biggest program of the year. We'll have a load of investors in the room for those of you raising funding. We invite you to come. I've just put the link to register in the chat area so that you can do so. You're on the mailing list now, so until you unsubscribe, you'll be getting some notifications about this over the next weeks to come. If you're planning to be in Glasgow for COP26, even if you're not, we'll be live streaming the event, but there will be a live program with drinks, with canapes after the fact, and 26 companies doing a series of 2-minute speed pitching. You should come just for that. It's going to be quite lively there, and we'd love to have you join us. Sarah, is there anything else that you wish to say before we bring it to a close?
Just to say, if you want to email, please do. If LinkedIn's easier, I am on LinkedIn as well. I will get back to you. It may be the weekend. Sorry, it gets a little bit frantic during the week. But I will make sure that I get back to you guys. And I will be at COP26. Glasgow's actually my hometown. So I'm looking forward to being up there and seeing you all there as well.
Well, we hope to see you there. And Sarah, thank you very much for this session. Quite a lot. I think we could have been on for another half hour at least. But this has been great. Everybody, you'll get the replay to the session. Thanks very much for joining us, and hopefully we'll see you at COP26. I'm going to stay on the line for another 10-15 minutes. If anybody wants to talk about anything at all, you're welcome, even if it's the weather. So
I'll stay on as well if anybody has any more questions.
Fantastic.
I can see messages.
Yes, a lot of thank yous. Let's see if there are any questions in here. So yeah, somebody said might be worth extending to an hour to facilitate more Q&A. maybe we'll have to consider that.
Yeah.
But I think we have captured most of the, if not all of the questions.
There's one just come in. How about terms with international investors? So I can cover that if you want me to.
Sure.
So I actually do some investment in the US. I'm actually quasi general counsel for US funds. So I would say that the US leads the way in terms of venture. Europe often follows behind. US investors, because the market is so hot over there, the terms are a wee bit more lenient. So for example, you would always get a one times non-participating preference in the US with investors. Investors are also, there's so many in the US that my investor always says to me is like, we just don't want to go in hard because we'll get a bad reputation in the market and we won't get any deals coming to us. It's a very developed market. So I think, there's a lot more pushback for founders there. In terms of Europe, Europe generally follows the UK. I would always advise that you try and do your deals under English law. One, it's a more developed legal market. Two, the venture terms are more developed and people don't argue with them as greatly as they do probably elsewhere in Europe. And I have to be honest, I think UK probably leads Europe on venture.
There's just some other. So Sarah.
Yeah, my family actually don't live in Glasgow, but I'll tell my friends that they might want to start putting their apartments on Airbnb or something. I like that question. Okay. So I'm just gonna go underneath.
A lot of things flooding in right now.
Yeah. Nicholas Payne asked, what's the timing of such an agreement? I guess what you're talking about here is when you want to get your term sheet in place. Once your term sheet's signed, you're pretty much ready to go through and draft your investment agreement and your subscription agreement. The only kind of nuance with that is if you have multiple investors that are showing an interest. Some investors have to go through what they call an investment committee. Those investment committees might only meet twice a month. And so they might not be at the same stage as their other investors. You can, if you need the money quickly, which often happens with companies, you can actually make provision in the document to be able to bring that investor in on the same terms. So I would say once you get your term sheet, you're ready to go. Getting that term sheet can take an awful lot of time. And I would, if you're thinking about fundraising, I would also always give yourself about 4 to 6 months to get yourself to that signed term sheet, and be aware that it's going to take you a lot of work.
If I could say something on this area, being on the deal making side of things, it's not unusual when we're giving guidance to founders in how long does it take from kicking off a fundraising round to actual drawdown of funds. We can see it going from 6 to 9 months plus. We've had term sheets signed, actually multiple term sheets on offer on a deal, only to take another 3 to 4 months to close those deals when it got to the contracts, to the commercial contracts, and prelude to drawdown of funds, and a lot of negotiation back and forth, due to perhaps the previous term sheets accepted not being as clean as they could be. So always time is the enemy of cash flow, but you should accommodate that. Sarah, I don't know if you have any extreme examples of that in action, but that's some of our experience.
One of the worst I've seen, and it was actually for an investor I was acting for, so I feel a little bit like Cruella de Vil when I say this. We got the term sheet. It took us about 6 weeks to get the documents in final form. We were about to sign the deal. I mean, literally the documents have been sent around for signature, and something came out from the founder that hadn't been, they hadn't informed the investor, and they didn't sign the deal. and the deal fell through, and that founder then had to go off and find additional cash. I think the lesson to learn from that is you're going into business with these people, be honest, be open, tell them about things. They'll often, if they love the business and they love you, then there'll be a way around things. So make sure that you're kind of disclosing everything that you should be disclosing at the right stage. So that's kind of initial discussions, due diligence, and in your disclosures. Disclosure's almost a little bit too late to be telling them, to be honest.
Yeah. And one of the questions that in the pool is whether there is a list or a source of for issues to consider for inclusions on a heads of term. To me, is that not just a function? It's got to be unique to each company. Is that not just a function of your initial term sheet review that you would conduct?
Yeah, so each investor will send you their term sheet, and the ideal place to be is to be in a position where you've got multiple investors with different term sheets, and you can almost like cherry pick, and it's like playing mom off against dad when you're a kid. Well, they're going to give me this, so will you give me that? And so the investor should send you a draft term sheet. That term sheet will include the provisions that they think are important. It doesn't mean that that is set in stone, and it's at that point that you start negotiation, and it's at that point you really want to be speaking to a lawyer. We will be, obviously Robert said this will go up online on LinkedIn and Greenbackers website. We will also post it onto our website, and we're actually, one of the things I didn't mention about Women in Business Hour is that we're going to be doing a blog. So we are encouraging people to submit questions, and we're going to answer them, and that will become a big resource that you can check, which will talk about venture and venture terms and term sheets and choosing chairman and things like that. All those questions that come up will be on there. Everything will be anonymized, so nobody will be able to work out that it's you. But that should be a really good resource for people to be able to check back about, what certain terms are and things that you want to be thinking about for your term sheet.
Very good. We'll take two more questions, and then I think we should, close it, bring it to a close. I mean, Jia Hong Shaw asked, do angel investors usually follow the agreed term sheets written by founders and or lead investor? That's an interesting question. I've seen both sides of that coin.
Yeah, angels. So I would put angels into two pots. There are experienced angels. Experience doesn't necessarily mean that they've been an angel investor for a long time. They might have been working in the investment environment, and it might be their first angel investment, but they know what they're doing. And those that are maybe, a little less experienced in the deal, and they might just do kind of a quick Google search and think, oh, I need to ask for this term, and it's entirely inappropriate. I think the more experienced one will know what should be in a term sheet and what shouldn't. I mean, ultimately, people are investing, particularly angels, they're investing in you for an economic return. And they might be investing in you, particularly you guys, because they want to make the planet a better place, but there's always that financial angle as well. And so they shouldn't really want to do anything that's going to make it difficult for you to grow the business. I would say that it really depends on the angel investor. And actually, if an angel investor is being unreasonable, I think the question that you need to ask yourself is whether you want that person to invest in your business. I mean, I understand sometimes it's the only option, but this person is going to be with you on a journey at a very early stage, and they should really be, you really want an angel who's going to make a difference to your business. And I think really you need to flip that question on its head. Robert, what do you think?
This is more to money or more to investment than the money. Really, there are the intangibles. There's good corporate governance that angels can bring to the table. There are contacts, there are market opportunities. It's not always about the cash, although that is the whole purpose of a fundraising around. That's my input. The last question that I'll take, Philip Morkel says we're a startup that's bootstrapped up to Series A Is there a difference when we're going into a series of 12 projects in the way that we set up term sheets compared to others? I don't know, Philip, do you want to come off a mic to give a little bit more color on that, please?
Oh, I can't hear you.
No, we're not getting it, Philip. Oh, sorry. I mean, Sarah, oh, there we go. You're on there now.
Sorry there. Yeah, Vancouver time, it's early in the morning.
No worries. I do it all the time.
Yeah, so we've got quite a long way down the road, invested a lot, spent some time, etc. Does it make it easier that we're not going to have to deal with a lot of angels and so on up front? I guess we're going to be faced with the possibility of big chunks of investment. You know, this is the first raise is probably $35 million. Does that change the way you look at the term sheet now in terms of this? How it's set up, etc., or is it still pretty much the same pattern that you follow as you've described?
To me, it's the same pattern. The big difference for you, because you've got 12 projects lined up, is going to be your valuation. So as soon as you get traction, that drives your valuation, and you can stand behind it for good reason. But all the same terms will be in there. What I would try to do though is raise big chunks of your cash. You don't want lots of little investors. We had a company, to give you an example, we had a company that did crowdfunding quite a few times, and they have something like 1,400 shareholders. Okay. And every time we try to do something, we have to hold a general meeting that involves circulars and all the rest of it. So try and raise your 35 million in big chunks.
I didn't put it in there, but part of this is that the 12 projects are split between 2 countries, and there is a possibility that we could go for a different ownership on each of those. Does that affect the term sheet in the beginning?
That is not necessarily going to affect the term sheet. It's going to affect the investment decision, and by the investors, I think, because you need to be careful in the way that you split it out and how the IP is held and things like that. Robert was probably better to talk to this than me.
I'd be happy to take that offline, and as Sarah has said, Brown Rudnick offers a consultation to run through, you know, from soup to nuts, you know, with respect to the term sheet. We've got a lot of views on good fundraising practice, but you know, there's a lot more color that we not a lot more detail that we'd need to know prior to that. You've got my email address from the invitation. We'll be sending your links out tomorrow with more information. We're happy to have a conversation for your Series A, and well done for bootstrapping up to this point. That's not always an easy thing to do. You know, you still have hair on your head. All respect.
Yeah.
So,
$3 million later, it is tough to do that.
I get that. Well, you know, somebody said we should go an hour, and an hour we have just gone. So thank you all very much. And Sarah, once again, thank you for you know, a fascinating, you know, insight into your world, and which impacts our world so dramatically. So you know, thanks again. Regards to Neil Foster. And look forward to seeing you all at the COP, or at least joining us on the online session. It's going to be awesome. So thanks very much, and onwards and upwards.
See you later, guys. Bye.
Bye.
Thanks, Robert.